Well, I think I'm going to sound like a broken record up here. You know, in terms of the money, the capital, you refer to that as the scalpel. You know, the decision making of who has access to this capital. First of all, Congress, and you in your question you used them as part of your question. I mean, Congress took the step of authorizing the expenditure of up to $700 billion. There were some parameters around how that money would be spent, but a lot of the authority on how to use that money then was handed to the Treasury, and you know, and then assisting the Treasury has been the federal regulators, because that capital is available to banks that are viable banks, ongoing entities, and the regulators of those banks, whether it's the Federal Reserve in the cases of state chartered banks, or the OCC, the Office of the Comptroller of the Currency, in the cases of national banks, are giving information to the decision makers, the Treasury, as to whether these institutions, these banks that are applying for the capital, are healthy. So I think that there are people involved that do have knowledge and expertise and the appropriate background to make decisions on who has access to the capital.
Ms. Pianalto, what do you think that the effect of the Federal Reserve's lowering the interest rate to historic lows in the recent several years had upon the housing bust and boom? And in the area of regulation, I just happened to be reading the book on a wild bill on Justice William O. Douglas, who was very instrumental in affecting and clamping down on regulation and making new regulation on the SEC in the early 30s.
You are correct in the fact that you know, our federal funds rate, which is now at 1%, is at near historic lows. This is one of those times, though, that history is short, because I was a Federal Reserve policymaker in 2003 and 2004 when we brought our Fed funds rate target down to that 1% rate at that period of time. At that period of time, we took those actions because we were actually facing a slow economic environment, but also we were concerned that we were going to enter a period of deflation. You know, we had just come off we're coming out of a recession. We had the 9/11 attacks. There were a lot of shocks to our economy, including accounting scandals. And so we took the actions to bring our rates down to historic levels in response to the economic environment and to our thinking about the economic outlook ahead of us, and concern, again, that we would be entering a deflationary period. We had watched Japan deal with a deflationary period and wanted to avoid that. You know, so bringing our interest rates down to historic lows, again, our response to our looking out at the economic landscape, and as I mentioned in my remarks, seeing some subpar growth on our economy for several quarters, and so you know, that's been our response. You know, after and we'll continue to look at the forecasts and continue to make adjustments to our policy as needed.
Hi, Ms. Pianalto. It's a pleasure to meet you. I'm Sean Ryan. Piggybacking off of the gentleman's question, I think what he was getting at was that it might have been the artificial expansion of credit following the dot-com bust that was the true root cause of this crazy housing speculation, and that if credit hadn't been so cheap, investors might not have been so foolish. So my question for you is, when you're meeting with the Federal Open Market Committee and weighing the pros and cons of altering interest rates, do you ever consider the possibility that no man or woman will ever be intelligent enough and informed enough to guess correctly what the current price of money should be, and that it might be wise to consider letting the free market determine how much liquidity is in circulation.
Our role as the Federal Reserve, we have a dual mandate, and that is to make sure that prices are stable, price stability mandate, and to provide an environment where the economy can grow at its maximum sustainable level. So that's the role we play. Just as I described as the answer to the gentleman's question about, when the last time we brought our rates down to this historic low, we were focused on our price stability mandate. Prices were falling, and our responsibility is to bring them to a stable level around a range that seems appropriate for a price stability mandate. So your comment about, is any human being, smart enough to know, how to set the price for various assets, including money? No, that's why the marketplace does work. But our role in that marketplace is to provide, first and foremost, a stable price environment. Because if we allow inflation to get either too low or too high, then that makes it very difficult for any market participant to know how to price assets. If they're trying to decide what the true value of a good or service is, and we've provided too much inflation to that environment, then that adds noise into the pricing of those goods and services. So our role is to not introduce noise into that equation so that businesses can determine the prices of the goods and services that they are offering based on the demands and willingness for consumers to pay for those prices and services. So we're not interfering trying to set prices. Our role is to provide an environment where the marketplace can make the decisions on what those prices of goods and services should be.
Thank you very much, Sandy. Today you've been listening to Ms. Sandra Pianalto, President of Federal Reserve Bank of Cleveland. We thank you for your attendance, ladies and gentlemen. Have a good weekend. This meeting is now adjourned.
For information on upcoming speakers or for podcasts of the City Club, go to cityclub.org.